Hi there, good afternoon. This is the Mutual Fund Corner, a show where we answer all your mutual fund investment related queries. I'm Mangla Malu. With me is Reema Tendulkar. Like every Tuesday and Thursday, we answer all your mutual fund related queries. Before we do that, a quick look at the markets. Well, the Nifty has faced a fairly choppy session right now, currently consolidating around the flat line. In fact, it's been doing so for the last couple of hours, and that's primarily because it is expiry, so maybe a lot of the option writers eating into the premium. A couple of things really stand out. The first one is the underperformance of the Nifty Bank, which is lower by almost 0.75%, and secondly, the outperformance that we're seeing from the mid-cap index, close to the 15,500 mark for the mid-cap index. More stocks advancing than declining. In fact, as we speak, very interesting to see the kind of stocks which are moving. We have Dish TV, which has taken a drubbing, and intuitively it's a stock that should have been weak given the fact that Reliance is launching its new vertical ray Jio Fiber. We have Reliance Capital doing well. We have Arvind as well, a stock which has lost almost 48% this year, which is doing well. So let's see whether this is short covering or there is more in order. But hi Reema.
Hi Mangalam. For now, at least the Nifty and the Sensex have settled lower in the last 2 hours of trade. So the Nifty has lost about 80 points from the top of the trading session, and the Nifty Bank has pretty much given up all of yesterday's gains. But let's get straight away to addressing all your mutual fund queries. Joining us today, we've got Kaustubh Belapurkar of Morningstar Investment Advisor to answer all your queries. The first one, which is coming in, it's an SMS. So B. Jagdish has written to us from Bengaluru. He has investments in multiple funds and he wants Kaustubh to assess his portfolio. So let's just get his investments up for you on your screen. So we just so all our viewers are apprised of what it is. So he's got an investment in a long-term fund, a small cap fund, a blue chip fund, so pretty much diversified. It's a discovery fund. Kaustubh, I think if you have the details, if you could just tell us what his total investment value is, what his horizon is, and what his ultimate goal is, and is he going down the right track?
So, I think broadly, if I look at, the funds that he's holding, largely in place, but just given, if I just look at where he stands in terms of his current age and his investing, a couple of comments that I would make is that he clearly, if he's got the investment time horizon, the risk profile, I wouldn't mind adding some proportion of slightly what we call the risk assets, while he's got his, he's got some excellent funds in place in terms of the large cap, multi-cap value, so that mix is good, but he's got a couple of small cap funds, which is probably like 15% of his portfolio. I wouldn't mind adding some mid-cap exposure to his portfolio, taking that up to about inching up to 25-30%, but this very, very strong sort of message around that. Obviously there's been a lot of pessimism around this counter given just the sharp drawdowns that we've seen on the small and mid cap side, but clearly if you have a 7-10 year horizon, if not more, I think this is a good space to be there, as long as you can understand that you've got to weather the storm in between, and we've seen this is nothing new. I mean, it's happened time and again where these counters will fall dramatically more than the large cap counterpart. So I think that's just something that he needs to keep in mind. But definitely I would want to take that up a couple of notches, add about 10% odd into mid-cap sort of stuff.
Any particular mid-cap schemes that you would recommend, and would you recommend any reallocation from his current investments?
Yeah, so I would say that there are a couple of names that we like in terms of the Franklin India Prima Fund, the HDFC Mid-Cap Opportunities, the DSP Mid-Cap. These are three funds sort of which have traditionally been really well managed mid-cap funds, and we would urge him to look at one or two of these names to allocate to his portfolio. So he'll probably have to reshuffle from taking out some from his sort of larger multi-cap exposure to kind of move it to that, but that's something he would be comfortable with.
All right, fair point there. There is Jagdish's portfolio that Kaustubh had assessed. Jagdish, of course, is a 27-year-old guy, so maybe his risk profile seems like it is slightly more on the riskier side than risk averse. But from a larger investor standpoint, you spoke about mid-cap and small-cap funds. We have seen a fair amount of drubbing in those indices. The mid-cap index is down around 40% from its all-time high. So would it, from a general investor perspective, also be a good time to initiate SIPs right now, or maybe wait?
Yeah, so I think the way I would look at it is that everyone kind of just needs to go back to their drawing board and reassess where their current allocations lie, and if they're under allocated to mid-caps, then most definitely so. I mean, it's not a sort of broad stroke saying that, okay, if mid caps have dropped off, the cliff, so to speak, we can just go ahead and blindly allocate. The investor needs to be kind of within his risk return asset allocation metrics, actually be under allocated. If he's under owning, then it's a good time to kind of add up. But if he's already overexposed, I don't want someone taking on additional exposure if he's already kind of 40-50% plus, and his bands don't allow more than that, then you clearly don't want to be adding on just because it's probably a little better.
So if you're in your mid-20s or up to say 40, when you have the risk profile to add into mid caps or small caps, what would be the optimum amount of mid caps and small caps in your portfolio?
So again, I would say it's a moving number, and this is something that each individual need to evaluate. But
approximately,
so I would say even 30% is a good number, right? But a couple of things to keep in mind is that you don't need that money. You're not going to touch that money for the next 7-10 years, because we've seen market cycles can be quite brutal. Mid caps probably won't make money for 3-4 years and then suddenly come back in a strong way. So I think that's something very important to keep in mind. And clearly, if he's a guy who's going to react to sort of negative news and start panicking and start moving out of mid caps because they've fallen 20-30%, because investors tell you one thing, but if they can't take that kind of drawdowns, then they're probably better off into more sort of diversified large cap sort of funds.
All right, that's a fair point. In fact, that actually segues into our next question quite smoothly. We have Mr. Subbarao, who's written to us from Bengaluru, wants to know that is this the right time to invest in mutual funds via SIP? Wants recommendations on the same. Remember, he's a 48-year-old person who's retired as well, so maybe not as risk-seeking as our previous viewers or the ones you were talking about with regards to increasing exposure in the mid-cap space.
Yeah, absolutely. So, the circumstances for this gentleman will be quite different. And again, some of the broader points remain intact in terms of, you want to know what your investment time horizon is, what are the goals that you're going to be driving home, because if you need the money, say for buying a house or an education for your children that's coming up sooner rather than later, then you want to get into the most safer or the less volatile asset classes, which would probably be driven by more large caps. You would have a greater component of fixed income in your portfolio, and again, within fixed income also, you probably want to be in the slightly less risky asset classes, so not get into funds that maybe go down.
Any names off the cuff?
So on the fixed income side, short duration funds, be it an ICICI short duration, Kotak, IDFC short duration, these are funds that traditionally take more sort of AAA rated exposure. There are a couple of corporate bond funds that traditionally buy. The mandate of the fund itself is to buy 85% of the portfolio or plus into AA plus and above rated securities. So an HDFC corporate bond, be one of the names that comes to mind, which are the traditionally safer sort of credit portfolios, and those would probably be the funds that you would want to get into.
Okay, in the national news, which is just coming in, P. Chidambaram, who has been embroiled in 2 corruption cases. One is the INX Media and the other one is in the SL Maxis case, has at least got relief in the SL Maxis case. So P. Chidambaram has been granted interim relief. He cannot leave India without notifying the court. So that's news which is just coming in. Get into a break on that note. On the other side, we'll focus on more mutual fund queries, so stay with us. Welcome back. You're tuned into Your Stocks Mutual Fund Special. We're in conversation with Kaustubh Belapurkar, and before we get answering and cracking on more of our viewer queries, I think both of us had a query, because Motilal Oswal, Kaustubh, has launched a few index, mid-cap and small-cap index funds. Considering that they've been badgered, and if someone can invest for the longer term, is that something that you would recommend?
Sure. So, interesting context from an Indian perspective. We've always spoken about active management and alpha, and what we've seen, what's been happening over the last few years is that alpha has kind of been shrinking. We don't think alpha has gone away yet. There's still good active managers out there who can beat the benchmark. Obviously, it's been kind of dropped off a little bit, but index funds are actually a nice way for especially guys who who want to get into the market, probably sitting on the sidelines, don't know which fund manager to pick, because that becomes the crux of the point, right? That if not every manager is going to beat, an active manager is going to beat the benchmark, can you actually pick the guy who's going to do it? So if you don't want to be sitting out of the market but still want to invest rather than picking an active manager.
The alpha generation or the differential in terms of alpha would be much less in the large cap than the mid cap and small cap, where the alpha would be much more. So if one has to go to the index fund, should one then not take large cap and take an active fund for small and mid cap?
That would be the general sense, yes.
Yep.
Large caps, obviously the shrinkage has been greater.
Yep.
It is becoming harder and harder now. That's also a constrained universe. But again, it's not that it's gone away completely. But yes, that would be the natural transition, where, so if you see global markets like the US, passives rule over actives, because an average active manager just can't beat the benchmarks. But from an Indian context, that's still some time to go. But if you want to get into it, large caps would probably be the first way of doing it. But the point that I'm making is that it doesn't necessarily, a guy who just wants a plain buy and hold doesn't need to worry about, now there are great active managers there, but someone who doesn't want to bother about keeping that track on, okay, am I still in a good performing fund, or has the manager changed and things like that. A passive fund works beautifully because it just keeps tracking the index and you're kind of participating in the markets. So it doesn't have to be the entire part of your portfolio. It can always be like a small portion, 10-15%, depending on which asset class, which rather sub asset class, and you can actually get into that.
And last year, passive funds or index funds outperformed the active managers. Let's get in the next query that we've got. Tarak Nath has written to us from Kolkata. He wants recommendations on the best funds to invest in with a 3-year view. He's currently invested in SBI Equity Hybrid Fund. So those are the details that we have. What else would you recommend for him?
So I would clearly say that maybe the time horizon that he has for the fund that he's already invested in, I would want him to be a little more patient with that, because if you look at an equity hybrid fund, the fund by itself is good, but the problem is that with a fund that invests anywhere between 65 to 80% into equities, 3 years becomes a little bit of a constrained time period. So going forward, whatever additional investments he's making, I would urge Tarak to probably look at more fixed income funds, because he's got that hard stop of 3 years. If he's willing to extend it to about 5 years, then we can look at some equity funds. But if it's purely 3 years on the information that we have, then again, like I said, short duration and corporate bond, the cleaner credit is something that he can, and we have some names up for him. The other interesting category where if he wants to dabble a little bit in the equities, what we call the conservative allocation, which takes up to about 25% in equities.
Okay.
So it gives him some equity exposure, which is reasonably meaningful, but it doesn't really skew his portfolio towards equities.
Absolutely, and from the information that we have, he's 35 years old, so perhaps not very old as well, has a slightly higher risk profile than the others. But we have another query coming in. Amitav Sengupta, he writes to us from Kolkata, has investments in multiple funds, wants us to assess his portfolio. Now, just taking the name of his funds, he has L&T India Value Fund, L&T Emerging Business Fund, L&T Hybrid Equity Fund, L&T India Value Fund Growth again. So I think 4 of the 8 funds that he has belong to the same house, and the other funds that he has also belong to the same house. So is that a good strategy?
So I would say yes and no. Okay, and I'll tell you the reasons why. So in fact, when I looked at the portfolio, the first thing that I do is look at the commonality of the holdings.
Exactly.
And that's a very crucial point that you brought up. But if you look at these 4 funds, right, they're kind of from different buckets.
Okay.
And when I say different buckets, even the commonality of holdings is quite limited. Obviously, there's a small cap fund, there's a value strategy, there's a hybrid, which invests into equity and debt. So it's kind of a mixed bag, so to speak, with that. So the commonality is, the diversification comes through even if you're holding funds within the same asset manager. Obviously, a lot of them are managed by the same guy, which is one thing that you probably want to look at diversifying. But at least in terms of the portfolio construct, it's quite different. So in fact, the value is obviously managed by another person. But the idea is that you can get commonalities within portfolios, but it's not necessarily always the case if you're buying funds from the same fund house. Again, with the Mirai, it's got some commonality, but it's not or excessive because they are looking at different spectrums in the market. So I'm broadly okay, but yes, you can look at some of the other asset managers because the other thing is, the style of management that comes in. While, you might be looking across market capitalizations, just the different style in terms of growth value, you want to blend a little bit of that. He's got some of that coming through the value strategy that he owns, but you can actually bring in different manager styles, which will also help diversify his portfolio.
So any names that you have which are comparable to the ones that he has already?
So, the guys we like from HDFC, Templeton, ICICI, TSP, these are the names that, definitely he would look to add depending on, which segment of the portfolio he wants to get into.
Okay, let's move on then to the next query. It's Apurva Shah, who has written to us from Hyderabad. Now, his target is to achieve 2 crore rupees in the next 15 years with investments in his portfolios. He's currently investing about 32,000 rupees and he will be increasing his investment by 10% every year. So 32,000 seems to be his annual investment. He will monthly investment, and he will increase it by 10% every year. Some of his investments will come up for you on your screen. There is an ICICI Prudential Blue Chip, there is a Banking and Financial Services Fund, an MNC fund, a regular fund, there is a small cap direct fund, mid cap fund. So one is 32,000 on a monthly basis sufficient to achieve his target of 2 crore, and your thoughts on his choice of funds?
Yeah, sure. So if you just do the pure math and where he stands right now and looking, and I'm happy to know that he's talking about stepping up his SIP on a yearly basis, because that's really what he will need to do to achieve his targets. So if we just plug in the numbers, it looks like he's reasonably placed to achieve his target, starting at 32,000 rupees a month and then increasing it by 10% every year. But a couple of things that I'll just make a note of is, one is, it's largely, in fact, it is a pure equity driven portfolio. And again, while he's 35, obviously he's got a long-term goal of 15 years, but, we would still recommend adding about a 20% into fixed income. It doesn't really kill its returns that much, but it gives you that safety against volatility. And if there are any interim needs in terms of liquidity, it helps you a lot. The other thing that I'd want to do is, if I'm just looking down his portfolio, he's got a bunch of what we would call sectoral thematic plays, through an MNC or a banking and financial services. Now, it's great to have some exposure, but I think he's probably a tad over allocated to this. So I'd want to bring that down to 10% of his overall sort of SIP numbers. And the last thing, which we kind of touched upon in the previous question, is commonality between portfolios, right? So if you look at it, he's holding both the HDFC Top 100 and the equity. Now, both great funds, but the commonality between the two portfolios is actually quite huge. So there's almost a 75% overlap between the two. So if he's looking to diversify, you might want to look at another multi-cap fund like the Kotak Standard Multi-Cap, and stopping one of these, maybe the HDFC Equity. Purely because of the commonality between the two, so he can just build a little more diversification in his portfolio.
Kaustubh, thanks a lot for joining us and helping all our viewers with the queries. Meanwhile, we got some news coming in on